Hi everyone, welcome back to Be Rich. Me and Shashwat are being driven around in Bangalore, and we thought we'd quickly catch up again and talk about another roll-on effect from this Fed raising the interest rate and the curious thing that's happening to the tech sector in the American stock market. I'll let Shashwat first fill in, then we can talk about it a little more.
Yeah, I had recently written a piece along with my uncle in the Hindu business line. I guess 2 weeks ago. I'll put up the link in the description below.
We'll do that.
Yeah, but basically it talks about whether you should be investing, whether the intrinsic value method of discounted cash flow does that still work, and whether you need to be looking at interest rates in the present moment. What is the whole thing with discounted cash flow? And there was an article in the Mint which I don't recall now, but then the base by an author I don't recall. But basically, the article stated that discounted cash flow is a thing of the past, and that tech companies aren't going to be reliable investments anymore. That was the main argument. And based on that, the underlying argument he was making was that discounted cash flows, because for the past 10 years, interest rates have been exceedingly low, artificially low. It's been possible for investors to move on to riskier and riskier assets. But as of late, now that positive real interest rates, that is, inflation interest rate minus inflation rate is positive, it's not a negative number anymore. What the idea of the author was that now you shouldn't your discounted cash flows should be giving you muted valuations. You won't have sky high tech valuations anymore, and it's not viable to do what tech companies have been doing for the past 20 years anymore. And I think there's a point to that. The point and we're seeing tech companies getting more and more undervalued because you're seeing interest rates rise up and up and above and above and above. And the idea is basically this: when the treasury yield, which is a risk-free asset, is giving you about 5% or 5.5%, the question which investors are now asking, and you should be asking, is that why the hell am I going to give you a PE of 40 PE or 50 PE when I can just buy a treasury yield which is going to give me 5% today, right now, if I buy the treasury bond? Whereas you're promising me bumper profits like 10 years later, and you're telling me that the profits then will make up for everything which I'm paying you now in terms of valuation. So what investors have basically come out and said is that, that makes no more sense. You need to be valued a lot less. I need to pay you a lot less for what you're going to give me, because interest rates have now risen, so the discounting rate is now higher. So that is basically why tech stocks have been taking a beating. But they didn't take a beating the past few months only because of the AI stock boom which was happening. And that
Correct.
was basically animal spirits, in the sense that there was an external factor which was preventing the market from self correcting. And now that that AI boom is sort of run its course for the time being, we were seeing that the interest rates, which are the more persisting undercurrent, which is what is showing up right now in how tech stocks are being valued. And if you look at inflation protected bonds, TIPS, so treasury inflated protected securities also are now seeing a surge in value. And surge in value in the sense the yield is surging. And there's also talk of treasury auctions increasing in size, which means that you're going to have a sort of crowding out effect where interest rates are going to rise even further, because the government is now looking to bridge the gap between tax revenues versus expenditure. This could be with lesser expenditure, but also could be through borrowing more. And what this basically does, both of those two things will also lead interest rates to rise artificially. So these are two things which are also driving this rate rise and this tech stock battering. What do you think about this?
Yeah, I think you're absolutely right in what you're saying. And as an investor, what is this opportunity open as a long term investor? If you've been looking at some tech companies which you've been really keen on having in your portfolio, this might be a good time to look at it again, revisit it, because some of these are taking severe corrections, is there, and these corrections may be holding on for foreseeable future also. It's not going to be bouncing and going back up very soon. It's not like a temporary blip and the market will suddenly correct and go back up, because these interest rates and this cash flow constrictions which Shashwat was talking about is here to stay for quite a long time. And that being said, so which tech companies would you be recommending now, Shashwat, in this kind of a weather?
Well, we don't recommend anything on this channel. I'd say more of just an
Okay, let's say what are you educatedly looking at?
yeah, educatedly looking at. I'd say that we've talked about a few companies. I wouldn't really say tech companies because I feel like tech companies can still correct a lot more. And I feel like there's a sunk cost fallacy type thing which is going on right now where people aren't willing to accept that they might
True.
have been a little wrong or a lot wrong in a lot of cases in terms of how they've been valuing these companies. Because if you look at your Google or sorry, Alphabet and your Mang stocks, as we put it, they do continue to look a little bit overpriced. And I'd suggest that you this is a good opportunity. There's a good opportunity to start looking at them again. Before, it was the case that looking at them was also not worth it because you'd just be wasting your time.
Correct.
Right now, I don't think you'd be wasting your time. I think you're priming yourself in order to be able to buy these companies.
Correct.
And out of these companies, I'd suggest companies which have a high rate of free cash flow. So Alphabet is a company which I'm considering or looking at because it's a company which I enjoy the business model of, and I enjoy the monopoly which Alphabet does have in the search engine space. And Google has been fighting tooth and nail with EU regulators to put up an image saying that there are many competitors and we have many different businesses,
Correct.
and we aren't a monopoly. So when a company is fighting hard to prove that it's not a monopoly, it's a wonderful company for us to buy.
Correct.
And this might sound a little unethical, but yes, it's a great company to consider. And another company which I've been also looking at is Amazon, because I do like the fact that Amazon is also sort of a monopoly at this point. How many times can you recall going to a bookstore?
True.
It's very minimal. And forget bookstores, these days we Amazon Prime everything.
Correct.
So if you do see sort of value corrections in these companies, then it's definitely something you guys can consider. But that being said, you have to be very careful in terms of what valuations you purchase them at, because like Howard Marks put it very eloquently. He said that no company is a great asset at all prices, but all assets are great assets at some price.
True.
So as long as you find the right price valuation, then you definitely can be good to go. And I'd also suggest that if you wait for a few more months or a year ahead, while when the storm is really struck in and you're at the eye of the hurricane, so to speak, then you'd really be able to purchase some of these companies at wonderful valuations. Things have just started.
Correct.
And I'd say, yes, it's great to be excited, but excitement also leads you to get really disheartened.
Take poor decisions.
Yeah, take poor decisions and get disheartened when you don't see the valuations you want. So I'd say, temper your excitements a little, and but just keep looking at these companies because it's quite possible that some news might come out where there are layoffs, where these companies are thinning their staff.
Correct.
Because they're trying to clamp down on costs.
Yes.
And a lot of these companies which are running on debt, they're mainly the companies which are clamping down on costs, because with higher interest rates, these companies can't burn cash freely anymore. So if you want to burn cash, you have to pay for it. And these companies aren't going to be willing to pay for burning cash because they'll need to burn cash in the long term, and they won't be able to burn that much cash anymore. So I'd say be quite careful with that, and also be very vigilant, because you'll find wonderful opportunities. If news comes out that Alphabet has laid off, let's say, 2,000 employees or so, then you'll see the stock price correct a lot, and in that moment you might find it opportunistic to swoop in and buy a stock or two.
And remember what like Clariman said in that piece of his, that we are in an everything bubble, and this has been going on since 2007, 2008. There's free cash which has been flowing in. Yes, interest rates have marginally gone up. Things are hurting. Inflation is kind of right now in a stall mode. But like he said, we do not know where the bodies are buried in this, because it's been going on for so long. We do not know what lies under the water till the water starts receding, and we are far from that point.
Yes.
Far from the point of the water starting to move out. What has stopped is the water has not been filling.
It's not
up.
increasing anymore.
Yeah, not increasing anymore. So till the drain plug is pulled and it starts going down, we really can't see. So what prudent advice Ashwat has given is spot on. Do think about these companies. If you have a price in mind which you are okay with, and if it reaches these price points, do think about investing at a very small amount and starting very small, and not getting carried away and running into the market saying, oh my god, this is going to go away. These corrections are going to come, and many of them will come going forward. We're just in the beginning of it.
Yeah, and that being said, just keep your eyes peeled for more opportunities, and you'll definitely start seeing them soon. this is just a start. We've been waiting for a couple of years now, and we finally get the chance to purchase some of these companies which we couldn't even think of.
Thank you for watching Be Rich today. Do subscribe and turn on the bell notification of our channel so you'll be notified every time Shashwat Anand and me come up with something new for you. Thank you.
Thank you.